Hey guys, this is Julie. Going to have a traders workshop next week with NinjaTrader. I'm really excited about that and talk about these distributions. And for this episode next week, we're going to look a little bit more at the options pricing world. For the Black-Scholes model is what I use. I think most traders use some variation of the Black-Scholes model. And the JATS PT indicator, what it does, if you're not familiar, is it provides historical volatility across time frames using a model similar to Black-Scholes. I'm not using the interest or other things with the implied volatility. This is historical volatility, so it's a little different model. And don't ask me how I do it because this is proprietary and indicator that is available on NinjaTrader. But what you can do with it is plot historical volatility levels like a bell curve for any time frame, monthly, weekly, daily, minute, second. I don't use the range or volume or tick. I stick to the minute bars, and I don't use the Heikin or any of these. Minute bar is really second. I don't use a second either. Day, minute, range, week, month. If you get enough data, you can use year. My data supplier does not give me that enough that I can plot those. And we're going to talk about the days to use in your distributions in this video. So this is a quarterly distribution, and I can express that by month 3 and calculate it from the open and close or week 12. So there's 12 weeks in a quarter or 3 months. So you can do it either or. And so I just put them all on there, right? I want all the lines. So open and close, week 3, week 12, month 4, excuse me, month 3. Hello. Okay. So these horizontal yellow lines are the Black-Scholes model for the quarterly distribution. For E-mini, the quarterly expiry, December 16th. And I'm using Black-Scholes model and on calculating the volatility on the settlement. And that gives us the calculations that you see over here in the line. And if I scrunch this out, the way I like quick strike so much is they show us where those breaks are. See that how it goes from the red to the green? I'll show you how to do this. But then you can draw your line at that level like I've done on the chart, these yellow lines. And the mean, of course, is the yellow line in the middle. And it falls right inside my first standard deviation of the quarterly. The historical volatility does not match the implied volatility. It's a little different. And everyone, I believe, knows that in the option world. And everyone in the option world wants to know what that historical volatility is. And this is my distribution of that historical volatility. So you can see it matches pretty well with the Black-Scholes model for the options pricing. And this is for 3,000 days. It also matches pretty well. The silver lines are the JP Morgan color, and that is very critical to the market. We'll respect these levels also. And I've got them in silver, and you can see the silver lines are right outside the ones. So you never want to put your risk right on the one, right? You set it out a little bit, offset it to give a little wiggle room. And you can notice that they tighten up the bottom one much more sharply than the top one. The top one, they give a little bit more wiggle room. That was interesting to me. And I measured the points and was real excited to know what that variance was for, future memory hole. So the next time it gets up there, you won't have to give me an invitation. You'll probably know what I'll be doing. Um, sell high, buy low. Um, so with this distribution in mind and how it lays out so well with the option pricing sheet, you think that, why would I want historical volatility? Well, it's nice to have, but when you change, uh, and I can express this on daily, monthly, weekly, the same concepts. They come in at these standard deviation levels. Um, so if you're selling premium, you would know where to put your puts and calls outside this to sell the premium. Um, and you can see it, they keep it inside the distribution. So you know where to sell your premium at and collect your income each month. The distribution changes though when you put it on 5,000 days. And like magic, the distribution shifts, and now you know why that arrow is sitting there. Because the central bank, I think, the big hedge funds, banks, know that three sitting there on the quarterly, right? That's your quarterly three. And that is exactly where you would expect them, week 12, um, to come in. And you can see that it's either the quarterly three or the week 12 three, quarterly 12 or I'm going to mess this up, 13 different ways to Sunday. Weekly 12, monthly 3, whatever's the lowest of that range will usually be the end of the line, right? For their distributions. So now we know their secret. It does not match the pricing sheet, does it? So you need to have the historical volatility levels so that you can run your distributions on different time frames and see if you can find these edges, like I can on the quarterly, which was so, instrumental to have that knowledge that that three was down there versus looking at on a normal, range calculation that tracks Black Scholes very well that most everybody else is looking at. So, people, in the hedge fund world are, wondering, scratching their head at me, thinking I'm a lunatic because they see it in the middle of the distribution, right? When I was able to see it actually falling off the edge of the cliff. And that's why we got that big push. So we might be very close to the bottom, okay? If they come in and sweep the bottom and fat tail that 5,000 day distribution, that could happen, right? They could drop it down below that 5,000. Let me put it back on at 5,000. Actually, let me just duplicate so we can have one of each, because I will be doing this presentation next week in the Trader Workshop. So here's the 5,000 day. So you see the JP Morgan and the Black Scholes levels down here at 3,400, and just below 3,400 is the implied volatility range. And what I like to do is put a quarterly, monthly on one chart, and then come in. So you can see that's at 3,400. So when I add, there's your 3,400 right there that their levels are on. When I add my quarterly, monthly, weekly levels to it, I get extra real historical volatility levels below that. So if that becomes the fat tail and they wipe those stops out, because I guarantee you, if we check our quick strike and come over here and look at the open interest and look for those heat maps. Let me just make sure I have all my expirations on here. Nope, I don't have them. Okay. So if I look at 3400, and I need to add more rows. Right here, 35, 34, this row right here. Let's open this up. You can see it has the most volume, 12,430 sitting right there. And that's why I added that quarterly. See, that quarterly is the one I just added. So the quarterly contract has the most volume at 3,400, which is why you see the JP Morgan sitting where it is. That's their put wall, right? So they could actually, sweep those puts a little bit, shake them out. I mean, I don't know what's going to happen, but if that 34 breaks, the PT1 of the quarterly of the 3,000 day distribution, the Black-Scholes model that everybody can see, then where are they likely to go? And I think that that would probably be, here's the 3,400 for the weekly, monthly. Let me see, check my days here. Yeah, 33.22, maybe 33.13 would be the second standard deviation of the monthly. So a good bet is 3,300 is actually the absolute, safest place to be. 3,400 has a lot of safeguards here getting in front of it. So if it breaks this 34.53, it's likely that's going to be a straight shot to 3,400. It'll draw those, all that put one will draw them in real quick. So there's your, if there is a drop and pop, or whatever you call it, where it just flushes down real fast, that tail that we saw in the 10-year on CPI, where it just flushes down and then pops back up, you know, I would look for this flush right here. It would go through 3,400. If I think if 34.53 breaks, it might bounce back up to 34.53, but this is going to be resistance, and then it's going to come back down. Something like that. You have to think of bank shots. But irregardless of what happens in here, this looks like safety to me. If that breaks, just thinking out loud, then there's your threes for the monthly. Um, but I think it would be a pretty safe bet that the twos would probably work first. If it breaks the one, go to the two. Something like that. And that's why I like my historical volatility levels, because I don't have to rely on implied volatility. I get to see more of what other people cannot see, and I can see that these statistical levels are relied on all the time. Now, they're granted, you can go crazy and put a ton of lines on your chart like I do, and it's like, well, which line is it going to go to? And that is the art, right, of trading, figuring out where your highs and lows are, and using your other analytical skills. I have a way to determine what the daily range is for a day or for a time period between 8 and 9 a.m., what that, high-low range has been over a historical time period. So I have a better driver's seat of understanding if I'm inside that range or outside that range, and that would help me understand whether I am looking to range expand or stay within a range. And that is the magic. Um, Having that second volatility slope to determine, is that a range expansion opportunity, or are we trading inside of a normal range period, nice and safe. I know where I'm at. I'm in my cocoon, my volatility cocoon, or am I breaking out, you know, trading directionally to my lower targets or upper targets after you get outside of volatility. That's when you go to your upper and lower targets. All right, kiddos. We'll see you next week. Stop by the Twitter or the website to register for the trader workshop and the JATS PT indicator. Again, I'm having a special offer next week. I don't do this very often. My sales maybe 2 or 3 times a year. That's pretty much it. Um, I you can register for the YouTube stream. It'll be a live stream. Just click that. And if you would like a platform, if you don't have the NinjaTrader platform, you can, that's just Gmail, sorry. Click that and tell them that you want the NinjaTrader vendor discount J Auto Trading Strategies, and you can get a discount of the platform. Save some money there, and then also the JATS PT levels are on sale. The indicator for NinjaTrader. Very good. So if you'd like to get a lifetime license, a good time to do it will be next week. So hope you register for the live stream. We'll be going through more markets, looking at more implied volatility levels and comparing those to the um, the way that the real volatility, historical volatility levels match up, and take a look at past examples of what price does when it gets at or on one of these levels, and determine that that might be an excellent time to actually, you know, send it back to the middle or the opposite side, coast to coast. Looky here. Um, PT3, PT3, 3 to 3. I mean, this is what trading is about, right? Right there. Yep, that's what it is about. All right, guys, thank you so much. See you next week. Y'all have a great weekend. And I'm going outside today. Yay! See you later.